Thank you very much. And thank you, President Lagarde, for the presentation. I have two questions. The first has to do with money market funds. According to a recent ECB bulletin, over the past decade, the prominence of money market funds and investment funds has significantly increased, with the total value of the latter sector assets more than doubling and reaching 15.5 trillion in mid-2020. You explained to us the policy that you are about to follow, but could you please tell us what was the effect of the pandemic on this dynamic in favor of money market funds? The dynamic in favor of money market funds became stronger due to the pandemic, was controlled, and what do you expect for the immediate future, the next 2 or 3 years? And then I read an interesting and probably controversial article in the Financial Times by Neil Kaskari, President and Chief Executive of the Federal Reserve Bank of Minneapolis, who oversaw the Troubled Asset Relief Program in 2008-2009. The title is, "Banks Cannot Expect the Government to Bail Them Out of Every Crisis." And this gentleman concludes that analysis by the Minneapolis Fed and numerous outside experts indicates banks need about 20% equity funding, up from about 13% today, to protect against deep economic downturns, such as another housing bust or pandemic. Banks fight against such proposals because higher equity levels will hurt their share prices. What is your opinion about this statement, and how do you compare the situation in the United States with the European situation? Thank you very much.
Well, thank you very much, Mr. Georgios, for this twofold question. On the first one, I've touched on the money market fund issue briefly during my introductory remarks, but let me just add a little bit to that. We have observed at the time of March 2020, financial market turmoil at the onset of the pandemic outbreak. And that has revealed that there were some areas of the financial markets which, despite the regulatory efforts that was undertaken after the 2008 crisis, that some sectors had not been sufficiently identified as potential source of systemic risks. So some money markets funds investing in private sector debt securities faced acute liquidity strains when they experienced large redemption from investors, combined with lack of liquidity in private money markets. So the ESRB identified those systemic vulnerabilities, and they are inherent, really, to the business model of money market funds. Those funds are key intermediaries in the financial system, but their business models embeds a tension which arises from the fact that they offer on-demand liquidity, and they're considered as such by their users. And those investors consider them like, cash-like instruments. But the instruments in which the funds invest are not reliably liquid, especially during stress periods. So what we've also identified is a broad set of policy options to address those vulnerabilities going forward. We identified 3 key vulnerabilities and potential policy outcome. First, to remove first-mover advantages for investors, which was also a key consideration in the previous ESRB recommendation on money market funds that we issued back in 2012. Second, not to limit the proposals to any specific type of funds, but to consider the vulnerabilities of the entire sector. And third, to ensure the resilience and functioning of money market funds without the need, as we experienced it in March last year, to actually step in the middle of a crisis. Now, the FSB yesterday came out with some recommendations as well that are more specific, different from the ones that we are identifying as probable areas of further research and recommendations. But I think that the combination of all institutions from ESMA, IOSCO, FSB and the ESRB coming together with an in-depth analysis of the risks to which the system is exposed as a result of the dichotomy in the business model of the money market funds, I think will help us with better stability going forward. So that's in response to your first question. In response to your second question, what we have seen in the course of this health and economic crisis. I'm not going to use the word financial crisis because precisely because of the regulatory measures and because of the good supervision as well as the fiscal and monetary policies that were decided, we did not see the amplifying effect caused by the financial crisis as we had back in 2008. So what we observed is, number one, that because of the regulatory measures that had been taken, because of the supervisory work that had been done, the financial sector and the banking sector in particular held. And this is, in part certainly attributable to the fact that the capital ratios in particular of the banks were much higher than what it had been back in 2008. I think that the capital ratio is hovering, depending on countries and banks, but at an average of a little more than 15%, which is almost double, not quite, but almost double the capital ratios that banks evidenced back in the crisis. Now, I have not read the Minneapolis Fed President op-ed in the Financial Times, and I'm sure that I will do that now that you've signaled it to me. But it is clear that the imperative is to continue to have a strong backbone of capital for banks to actually deliver to the Basel III commitments that have been agreed and to actually stick to the timeline that has been identified to make sure that the financial sector is of support in case of crisis and not an amplifier going forward. So I think all of that clearly pleads for this strong capital base that has been so much reinforced over the course of the last 10 years in the banking sector of Europe. Thank you.
Thank you very much. Now I give the floor to Marek Belka from SND.
Thank you. Thank you. Good morning, Madam President.
Please, Marek. Sorry, I think you should keep your mask while speaking. Thank you. Okay. I'm sorry.
It will help interpreters, of course. Good morning, Madam President. I'd like to make an observation at the beginning. When I look back 10 years ago, when the ECRB was created, the financial stability situation was really much more different, much more severe. So it tells us that we have learned a lot of lessons, and the financial stability institutions, the institutional framework works. Still, I remember at that time there was one issue that we were worried about. It was the infamous doom loop, which means the excessive sovereign exposure of commercial banks. Well, we were worried. We did nothing because the issue was controversial politically, and also justifiably, if the thing would be dealt with improperly, it would exacerbate rather than mitigate the crisis. Well, what happened in the meantime? Probably the sovereign exposure of banks increased even. But now we don't treat it as a big problem, it seems. So the question is, are we still doing nothing, just following closely the matter, or do we think that the dangers connected with the infamous doom loop are mitigated? Well, we don't talk about the possible default of countries, but we still cannot exclude different volatility or volatility of yields that can complicate the situation of banks in certain countries. Are we doing anything about it, or do we think that this is an issue not really important for the coming future? Thank you.
Thank you so much, Mr. Belka. I was going to say Mr. President, given that you were president of the World Bank Development Committee, if I recall, and I'm very happy to see you. So, of course, the ESRB is monitoring very, very closely and very carefully this nexus, as we call it, between the sovereign and the banks in that particular in relation to the exposure of such banks. You call it the doom loop, which is what troubled me a little bit, but it's more like the nexus, as we call it. And we have observed that during the pandemic, the outstanding exposure of banks had increased. And I just want to give you the exact numbers, because I think that there are two phenomena that we've observed in the course of this last 18 months. Number one, it has increased by approximately 16% between February 20 and March 21, 16%, but by around 11% when excluding valuation effects. So it's that we're talking about that magnitude. The second phenomenon, so increase. Second phenomenon that we observed is that whereas in the period surrounding the great financial crisis, the exposure of banks were very much limited or concentrated, if you wish, to their domestic sovereign. Whereas in this particular circumstances, we have seen more variety and an exposure that was not only to the domestic bonds, but to other bonds as well. So risks are more scattered and not as concentrated in the increase that we have seen in the recent months. This increase in bank exposure to domestic sovereign debt has actually reversed partially since September, as obviously government bond issuance slowed down. And if I give you the numbers of exposures relative to total assets, so banks' exposure to sovereign, domestic and others, relative to their total assets, it currently stands at 3.3% of total assets. That's the number for March 2021. So we monitor that very carefully. We analyze the composition, the diversity of risk exposure, and at this point in time, we see limited near-term risks to the bank sovereign nexus. Why? Because number one, favorable borrowing conditions and the temporary EU-level joint debt issuance should alleviate any near-term sovereign debt sustainability challenges. Number two, because banks are benefiting from low financing costs. And number three, because the risk of reinvigorated sovereign bank nexus is particularly pronounced in countries where banks did not reduce their exposure to domestic sovereign debt substantially since the sovereign debt crisis. So for those three reasons, we believe that the near-term risks are much limited. But in response to your concern, we remain extremely attentive and we monitor that very carefully. Thank you.
Thank you very much. Now I give the floor to Stéphanie Yancourtin for Renew.
Merci beaucoup, Madame.
Thank you very much, Madam President. And also welcome to President Lagarde. Very pleased to hear you in ECON this morning. Now, solvency of companies is a big issue. You were saying that that could affect stability. There was a report last year that talked about the possibility of dealing with a wave of company insolvencies. Do we need a harmonization of the European rules on insolvency, or at least across the Eurozone? Do we need to make progress in targeted areas? Which areas would you target in that case? My second question is on climate change risk. The European Systemic Risk Board and the ECB have been looking at the climate risk of the whole European economic ecosystem. And Frank Anderson has called for action on the part of the ECB. Well, you've mentioned this on a number of occasions, but what kind of actions can we take to try and alleviate the pressure on insurance funds and investment funds? As for the money market funds, the ESRB seems to be very involved in drafting recommendations. So what about the role of the market supervisors in this picture? How can we ensure that at the European and international level that supervisors and central banks work together on money market funds?
Well, thank you very much, Madame Stéphanie Yon Courtin, and it's always a pleasure to meet on screen with a fellow from Normandy. So thank you very much for your three questions. I'll try to address the three of them in turn. Number one, on the insolvency front, we have seen an interesting phenomenon of a rather low level of insolvency and filing for insolvency over the last few months, certainly less so than what had been anticipated. But what is difficult is to actually assess how large a potential backlog of insolvencies might be, might there be in the pipeline, if you will. But we still nonetheless expect that bankruptcies will be more frequent and there will be a catch-up element about it as we see guarantees, PEG, as is well known in France, and some moratoria measures gradually phase out. So we still expect that backlog release to take place. And it will be so in particular sectors. When we look at the ramp-up of insolvencies filings at the moment, it is clear that both in the transportation business, in the leasing business, in the hospitality business, there is a clear rise compared with the rest of the economic sectors. And you asked me whether I would welcome harmonization of insolvency rules. It's a triple yes. Yes, because it's been much designed and expected for a long time. Second, because it's one of the brake on the potential development of capital market union. And third, because I believe that if we want to develop in Europe, and particularly in the euro area, a capital market union that is specifically dedicated to green financial products, we have to move forward with as much common denominator of insolvency procedures and rules as possible, because we would like to avoid that this break slows down the process of development of this green bonds and green other financial products development is taking place in Europe. I've recently given a speech on that particular topic, and I'm very keen to, or very hopeful that these developments will take place. Your second point on climate change and how beyond the call for action, what can be done? Well, the ESRB does everything it can in that respect by identifying the risks, collecting as much data as possible, being as vocal as it can to flag the risks and to signal to the financial sector what is on this horizon and how this horizon is coming forward. towards us. That's what the ESRB can do best, as well as suggesting that its membership at large also takes action and looks at what possible remedies can be taken. I think you specifically pointed out to measures that would affect some sectors, and it is clear that the insurance sector in particular participates in reducing the climate change risks, and this certainly should be encouraged. On the money market funds, I tried to explain what we were doing, and this will be published more clearly and specifically today. We're going to continue working on it, and there will be a further publication with detailed recommendations in our next publication later in September. We're not the only one, as I said. So ESMA is also doing some work, is also doing some exploring of further modifications. The Financial Stability Board yesterday came up with various recommendations. So I think that all institutions that faced the March 20 turmoil, and where all central banks had to step in with a lot of coordination, I can assure you, all major central banks were comparing notes and trying to refine what they could do best in order to resist the potential turmoil. But the ESRB is also doing its bit and proposing, as I said, in three distinct areas, some proposals going forward. Thank you.
Thank you very much. Now I give the floor to Stasis Yakeliunas for the Greens.
Thank you, Chair. Good morning, Madame Lagarde. It's good to see you again. Let me turn your attention to a potential gap in the supervisory architecture in the financial area. That is the private pension systems. And to start, my comment and then question, let me quote from another excellent report, Lower for Longer, on the negative or lower interest rates. And a quote from page 10, insurance and pension funds have started to transfer investment risks to their customers. And then it follows, customers may manage the associated risks suboptimally by reacting in a way that increases procyclicality. Now, the private pension systems are quite heterogeneous in the EU and a number of countries, especially Central and Eastern European countries, be it Czech Republic, Poland, Hungary, and my home country, Lithuania, where I worked on the system, acted quite dramatically by cancelling the system, so restructuring that. I managed to separate that system, private pension system, from the pay-as-you-go system, where it was financed by pay-as-you-go system, which is, of course, nonsense. The financial industry didn't like my efforts, but we managed to deal with that. So these are quite complicated products to start with, the funded phase, then the payout phase. And when I look at the EIOPA's mandate or any other institution, there seems to be a significant gap where these private pension systems, except for PEP product, which is not active yet, it seems is not covered. In the organizational structure of ESRB, I saw some task force on insurance, but I didn't see anything on pensions, private pensions, I mean. So do you think it's important to put it on the radar screen, at least from your institution's perspective, and maybe incentivize Commission and others to supervise that on the European level? Because it has significant implications, I think, not only for the financial stability, but also for the capital markets union. Disrupting some of the systems or restructuring them or cancelling them affects significantly reputation of the institutions, both commercial institutions and supervisory institutions. So do you have any idea? Do you have any plans maybe? Or if not, would you consider putting something in the ESRB on the private pension systems? Thank you.
Well, thank you so much, Mr. Jakeliūnas. It's always a pleasure to see you as well. The risk and the category of risks that you are referring to is certainly something that the ESRB has identified. We are concerned about the sustainability of the business models of pension funds in particular, particularly those that offer longer-term return guarantees, as they are coming under increasing pressures when they have not, sort of balanced their exposure with the assets that they have invested in and that they have under management. So it is an area of risks that we've identified, and it's one that we will be looking at. We don't have a plan this year in the work that we are planning on doing to do a special report on it, but I'll certainly listen carefully to what you've identified, and we'll look it up and see whether we should have a special focus on that and produce a particular report in that respect. To an extent, it's also an issue that concerns the certain insurance products as well, and that might warrant some specific attention. But thank you very much for flagging it.
Thank you. Thank you very much. Now I give the floor to Hélène Laporte for the group ID.
Merci, Madame la Présidente.
Thank you, Chair. Thank you, Madame Lagarde, for these exchanges today. I have 3 questions, 2 more general ones, and then a last one on global economic policy. In general, the European sector is faced with on domestic sovereign risk, what do you consider we should envisage to cut the link between domestic debt and banks? My second question, along similar lines, the deposit guarantee system is still subject to negotiations between the 27. It would allow harmonisation for protection of depositors across the EU and therefore avoid a massive withdrawal or banking collapse in a case of crisis. Could you tell us the state of play of these reforms? And my last question, a new paradigm will appear in the European space with greater climate responsibility and joint green responsibility. But before the German elections, we can imagine the European sovereigns will continue to do the same as they've done this year and be sensitive to US Fed measures and look into slowing down quantitative easing. How do you imagine your monetary policy before the elections in Germany? Thank you.
Thank you very much, Madame Laporte, for your 3 questions. On the first one, it touches a little bit on the question that was put to me by Mr. Belka, and I will, in a way, confirm that while we have seen an increase of the exposure of banks to their domestic sovereign in the range of about 11%, taking valuation variation out of the picture, we have also observed a better allocation of risks, if you will, by less concentration of the exposure of banks to their domestic sovereign and more diversity of exposure to other sovereign than their domestic. So that's point number 1. And point number 2, we have also observed a slight reduction since September of the domestic of the exposure to domestic sovereign. But as I said to Mr. Belka, we are monitoring this nexus between the banks and the sovereign exposure. We don't think that it is a near-term major risk, and it's one that we will continue to monitor very carefully. Your second question relates to EDIS, as I understand. And it's obviously one of the key components of the 3rd pillar of banking union, one that has been under discussion at the Eurogroup in particular, and more broadly, which has not yet led to a conclusive timetable for completion of the discussions. I know that the president of the Eurogroup is intending on reactivating this discussion later in December, and we all look forward to a successful completion of these efforts, because it is clear that to be stronger, the EMU needs banking union, the EMU needs a capital market union, and that every effort should be undertaken in order to complete the two. On your third point, I can assure you that while there is a very good cooperation, a very good dialogue and regular consultation between central bank governors, including through the BIS and other institutions, as well as bilateral discussions between central bank governors, each of us, and certainly the ECB, decides its monetary policy independently, taking into account the environment within which our economies operate, and with an absolute focus on the mandate that each of us central banks have. The ECB has a mandate, which is price stability, which is very clear and straightforward. That's the one that is guiding us. And while we are very attentive to what is being done by other central banks and what the political landscape is around us, it is in a completely independent fashion that we deliver on our mandate. Thank you very much.
Thank you very much. Now I give the floor to Dimitris Papadimoulis for the left.
Ευχαριστώ, κυρία Πρόεδρε. Κυρία Lagarde, σας...
Thank you, Chair. Welcome, Ms. Lagarde. I would like to know, based on what the ESRB thinks and estimates, like you said, there's a great danger for a tsunami of corporate bankruptcy throughout Europe, especially once the support measures taper out. Especially for my country, Greece, you have projected an increase of bankruptcies of 20% compared to before the crisis, to 2019. On the other hand, the Greek plan for the recovery fund means that Greece is the only country where the whole amount that will be received, which is 13 billion euros, will be given through banks and almost totally to the big and very big businesses that are solvent, and that means that most of the small and medium enterprises will be shut out. I would like to ask you if you have a comment on this unique situation of excluding small and medium enterprises in Greece. The second one, do you see, I mean, it's you also as well that said that there is a serious risk concerning these systems of private pensions that have been established in the past few years, especially in the countries of Eastern Europe. There was also a question from a colleague a couple of moments ago. I mean, in the so-called old Europe, we have redistributive systems. Now, you said that this is a risk concerning these new private pension systems. Do you think that this is the right moment for a country that had a redistributive system to move to a system of private pensions? Because this is what Greece is attempting to do right now. I would like your opinion on that.
Thank you very much, Mr. Papadimoulis, and thank you for your two questions. On your first question, at the ESRB, we look at the risks. And in relation to bankruptcies, in relation to insolvencies, what we are clearly seeing and what we've identified as specific areas is, number one, the sectors that are most exposed, and number two, the categories of corporates that are most exposed. And on the first one, we have clearly identified the transportation and the leasing sectors, as well as the hotel, restaurants, leisure activities, resorts that I would put under the heading of hospitality business. So these are two sectoral activities that we know are at risk of potential release of the backlog of bankruptcy cases that have not been filed or that have been in the pipeline but not appearing yet in the numbers. On the categories of corporates, it is clear that those that are more at risks are SMEs. And it's a category of I say corporates, but I have entrepreneurs as well in my mind, that both banks and governments in their respective capacities should be particularly attentive to in order to make sure that those that are viable do not end up in solvency situation because they have not been supported in their journey back to viability. So every measures that can be taken in order to support those sectors, for those in those sectors that are viable, of course, are extremely welcome. And as I said in my introductory remarks, for those that are not viable and that would in any event not go through the recovery safely, then clearly solvency procedures, accelerated liquidation and reorganization format should be considered, and banks should be encouraged also to adopt on a case-by-case basis those debt restructuring measures that can be of help. On the pension fund risks, as I said, at the ESRB, it's been identified as that sector at large has been identified as a potential risk because of the eventual mismatch between the commitments and the business model that calls for particular investment in some sectors. And we will be doing some further work on that, most likely because this is now the second European Parliament member in the ECON who is signaling this particular aspect. Thank you.
Thank you very much. Now I give the floor to Aurore Laluc for the S&D Group.
Thank you, Chair. Dear Mrs. Lagarde, I will ask my question in French. Merci infiniment.
Thank you very much indeed for your regular appearances here in this Parliament to brief us on progress that's being made. Now, my first question, since you're speaking about actions, I'd like to ask about the not performing loans. I know that risk is manageable right now, but is it the case that, according to certain analysts, that in future crises, and we can expect future crises to come along, that we have more helicopter money in order to ward off banking risks? Now, on systemic risk, we're very, very pleased to see that you're working on this. Do we need to understand? We need to understand your actions more precisely. So, would it be possible to get an overview of the state of our banks? Right now, we do have these very hypothetical stress tests. They don't really tell us very much. They do provide a lot of data, but would it be possible to get an overview across the board so that we have a sort of a snapshot of the current situation? Because you will know that climate risk, the risk of non-action and missed objectives, is a systemic risk as well. So I think we need to do everything, pull out all the stops, and we're really pleased to hear that. So yes, we hear a lot of goodwill, a lot of good intentions, fine intentions, but it is still rather vague, and we have no time to lose now. So we can't afford to be vague. So we must act soon and decisively. So what, with regard to your recommendations, will you be discussing about the divesting from fossil fuels? Will you be talking, as we have suggested, on managing risks relating to fossil fuels. So if you say to banks, yes, if you fund fossil fuels, then you'll have to assume the risk yourselves. So these are some specific measures that could be considered. Because, we're going to have Finance Watch, Verso and others who are providing data, but I think it would be useful to have data provided by you, precise data and precise statements, not vague ones, because your statements have a huge impact, a huge weight right now, as you will know. Thank you.
Well, thank you very much. I'll try to be as precise as possible. I think the first part of your questions had to do with the non-performing loans. And on that one, what we have observed is an increase in absolute terms during 2020, but the ratios so far have remained stable, standing at 2.6% by the end of last year. Now, this is an aggregate number, and obviously within the European Union and within the euro area in particular, there are there is heterogeneity, and some banking systems have a higher percentage of non-performing loans. But what we have observed is a decline and a stabilization at this relatively low levels. However, forward-looking indicators suggest a perceptible deterioration in asset quality. So we are extremely attentive, in particular, to what is called the IFRS Stage 2 loans, those that appear to be slightly at risk. And that has increased recently. So we look very, very carefully at those numbers, and we'll be keeping you and our members obviously posted of any findings in that respect. The second part of your question had to do with having a grasp and a better understanding of the health of the banking sector in particular. And in that respect, there will be a lot of information and data coming out in the next few months. You will have the European Banking Authority, the EBA stress test that will come out reasonably soon. Then you will have another set of, and that will cover about 50-ish largest banks. Then you will have the SSM, the single supervisory mechanism, that will also issue a report of the stress tests that it has conducted and that it is completing now, which will cover more than 140 banks, if I recall. And next year, but I'm sure that you will see Mr. Enria soon, and you'll be able to put the question to him as well. But next year, there should be a stress test as well that will include climate change risks in particular, that will also give us a good picture of the health, the coverage, the identification of risks by the financial sector, and particularly the banking industry. So I think we will have plenty of data, plenty of good conclusions that we will look at us at the ESRB very carefully to see whether there is any signal that we should give, any recommendations that we should flag in order to respond to the to potential crisis, particularly in relation to climate change, as this was the core of your question. Thank you very much.
Okay, thank you very much. I have no more registered speakers, and I don't see requests for Catch the Eye. So I thank Madame Lagarde for her availability for this exchange, and I also thanked all the colleagues that participated, and we can move on to the next point in our agenda. So thank you again, Madame Lagarde.
A very good day, all of you. Thank you.
Okay, so now we move on to our next point in the agenda that concerns the public hearing with Andrea Enria, Chair of the Supervisory Board of the ECB. So I